When it rains, it pours. On the exact same day that we've witnessed the second largest bank failure in United States history, Wells Fargo experienced an unprecedented nationwide computer glitch that caused countless number of account holders to have incorrect balances and missing transactions. This is yet another example that demonstrates why it's never wise to put all of your eggs in one basket. If you have all of your money in just one bank, you may wake up one day and find that you are suddenly not able to access any of it. For years, I've been telling my readers to spread their assets around because our banking system is far more vulnerable than most people realize. In particular, I have never been a fan of Wells Fargo. A nationwide computer glitch at Wells Fargo left irate customers with incorrect balances and missing transactions Friday morning, sometimes dipping accounts into negative balances. Funds remain available, even though some customers' direct deposit transactions were not showing on their accounts, bank spokesman Josh Dunn said. Dunn did not say how many customers were impacted by the problem, did not provide a time when customers can expect the issue to be resolved, but he said Wells Fargo was working quickly on a resolution. As of 4:30 p.m. Friday, Dunn could not say when the problem would be resolved. The issue is one more reason people should keep cash on hand, one Twitter user wrote. Another tweeted, "I do not like to feel massive panic immediately upon waking, but Wells Fargo decided to give me that gift this morning." Others anticipated Chase Bank and Bank of America would see an influx of unhappy Wells Fargo customers. JP Morgan Chase is the nation's largest bank by assets at $3.2 trillion, and Charlotte-based Bank of America is its second largest with $2.4 trillion in assets. Another Wells Fargo customer tweeted about definitely closing their account, using a SpongeBob meme to show how they felt, like they were begging for money. Wells Fargo is further proof to keep cash on hand for use. In the blink of an eye, a computer glitch or whatever, your funds are inaccessible. The number one thing that you should want from any bank is security. Right now, Wells Fargo seems to be severely lacking in this area. When users try to log into their online banking apps, they received a very alarming message. It's not clear what might be causing the direct deposit issue or when it might be resolved, but Wells Fargo posted a message at the top of its online banking app saying, "If you see incorrect balances or missing transactions, this may be due to a technical issue and we apologize." Needless to say, a lot of account holders were not pleased. Of course, those that have their money in Silicon Valley Bank are in much worse shape. Rumors had caused a huge run on the bank in recent days. Regulators moved very quickly on Friday to permanently shut it down. The FDIC said in a press release that SVB was closed on Friday by the California Department of Financial Protection and Innovation, which in turn appointed FDIC as the receiver of all insured deposits of the bank. Those that have less than $250,000 deposited with SVB will be covered by FDIC insurance. But as I detailed in a video that we posted yesterday, the vast majority of the funds deposited with SVB are not covered by FDIC insurance. Some depositors are literally in danger of losing millions of dollars, and that should deeply alarm all of us. Meanwhile, there are now rumors that another major bank on the West Coast may be in jeopardy. Concerns have quickly shifted to other banks that might be in trouble. First Republic, another West Coast-based bank whose shares are down more than 30% since Wednesday, tried to reassure investors. In an unusual statement midday Friday, it said tech companies only account for 4% of its deposits and that less than 15% of its total assets are invested in securities like bonds. Is this the start of a new financial crisis? Some experts that were interviewed by CNN claim that this is not the case. Billionaire hedge fund manager Bill Ackman has compared SVB to Bear Stearns, the first lender to collapse at the start of the 2007-2008 global financial crisis. The risk and failure and deposit losses here is that the next least well-capitalized bank faces a run and fails, and the dominoes continue to fall, Ackman wrote on Twitter. Yet most analysts say the implosion of SVB appears company-specific for now. A crucial lender to U.S. technology startups, the bank came under pressure as Silicon Valley funding dried up, the result of an economic slowdown and rapidly rising interest rates. The reason SVB is in trouble is because they have exposure to particular industries, said Jonas Galterman, Deputy Chief Markets Economist at Capital Economics. Most other banks, he added, are more diversified. Federal regulators are paying attention to this particular financial institution, and when we think about the broader financial system, we're very confident in the ability and the resilience of the system, he told CNN in an exclusive interview. The comments come after Treasury Secretary Janet Yellen convened an unscheduled meeting of financial regulators to discuss the implosion of Silicon Valley Bank, a major lender to the hurting tech sector. We have the tools that are necessary to deal with incidents like what's happened to Silicon Valley Bank, Adeyemo said. There's also less anxiety about the stability of the banking sector due to the significant regulatory reforms put in place after the crisis in 2008. Still, SVB's collapse reveals stresses created by the fastest jump in borrowing costs in decades. Central banks have raised interest rates to tame high inflation, but the pace of the increases has thrown up unexpected problems, and worries persist about further unintended consequences. For example, banks that scooped up U.S. Treasuries and other bonds when interest rates were very low are now sitting on losses as borrowing costs have risen and bond prices have gone down. Mike Mayo, senior bank analyst at Wells Fargo, said the crisis at SVB might be an idiosyncratic situation. This is night and day versus the global financial crisis from 15 years ago, he told CNN's Julia Chatley Friday. Back then, he said, banks were taking excessive risks and people thought everything was fine. Now, everyone's concerned, but underneath the surface, the banks are more resilient than they've been in a generation. Similarly, former U.S. Treasury Secretary Larry Summers told Bloomberg News Friday that he saw no systemic risk if the situation is handled reasonably, adding he had every reason to think that it will be. In a sign concerns are spilling into other parts of the banking sector, shares of other lenders have been falling too. J.P. Morgan Chase, JPM, Bank of America, BAC, Wells Fargo, WFC, and Citigroup, C, all suffered drops of between 4% and 7% on Thursday. While their shares stabilized on Friday, smaller banks continue to suffer. An exchange-traded fund tracking regional banks, the SPDR S&P Regional Banking ETF, was down more than 6%. Banks in Europe were also hit. Overall, the banking system is in good shape and able to withstand significant shocks, said Jens Hagendorf, a finance professor at King's College London. I think SVB is special in the sense that they have a fickle depositor base. You can believe them if you want, but as I explained earlier, SVB got into trouble because they were sitting on mountains of treasury bills that rapidly lost value once the Fed started aggressively hiking interest rates. Unfortunately, there are lots of other banks that are in the exact same position. The financial day of reckoning that I've been warning about for a very long time appears to be rapidly approaching, and most Americans are not prepared for it at all. So if you have all of your money in a single institution, or if you have more than $250,000 in a single bank, I would encourage you to consider taking action while you still can. At this point, I'm sorry to report, no one is in a position to stop anything. Markets can be ferocious under these conditions. Markets are not all-knowing, but once they lose trust, there is no stopping the stampede of incredulity. There is no one at the Fed who can stop it, and no wise managers at the top who can patch things up. Take note of the collapse of bank stocks only hours after regulators took over SVB. My friends, we could be in for a wild ride.
The wait for the next Lehman Brothers moment is over. On Friday, we witnessed the second biggest bank failure in U.S. history. The stunning collapse of Silicon Valley Bank is shaking the financial world to the core. At the end of last year, the bank had $175 billion in deposits and approximately $151 billion of those deposits were uninsured. In other words, a lot of wealthy individuals and large companies are in danger of being wiped out. In particular, this is being described as an extinction-level event for tech startups because thousands of them did their banking with SVB. I cannot even begin to describe how cataclysmic this is going to be for the tech industry as a whole. There is so much to cover, so let me try to take this one step at a time. Rumors of trouble at SVB had sparked a massive bank run in recent days, and regulators moved quickly on Friday to permanently shut the bank down and took control of its deposits. The Federal Deposit Insurance Corporation announced Friday in what is the largest U.S. bank failure since the global financial crisis more than a decade ago. The collapse of SVB, a key player in the tech and venture capital community, leaves companies and wealthy individuals largely unsure of what will happen to their money. We haven't seen anything like this in a very long time. In fact, it is being reported that this is the second biggest bank failure in all of U.S. history. The closure marks the biggest bank failure since the 2008 financial crisis and the second largest in U.S. history after Washington Mutual collapsed during that industry-wide meltdown, according to FDIC data. As at the end of December, the Santa Clara, California-based bank, the 16th largest bank in the country, had $209 billion in assets with more than $175 billion in deposits. As with other FDIC member banks, SVB deposits are insured up to $250,000 per depositor. Worries over a run at SVB led Wall Street investors to dump other bank stocks as well. Shares of some prominent West Coast lenders took sharp nosedives on Friday, including First Republic Bank, PacWest Bancorp, and Western Alliance Bank Corporation. The good news is that anyone that had less than $250,000 in the bank will be covered by FDIC insurance. The FDIC standard insurance covers up to $250,000 per depositor per bank for each account ownership category. The FDIC said uninsured depositors will get receivership certificates for their balances. The regulator said it will pay uninsured depositors an advance dividend within the next week, with potential additional dividend payments as the regulator sells SVB's assets. Whether depositors with more than $250,000 ultimately get all their money back will be determined by the amount of money the regulator gets as it sells Silicon Valley assets or if another bank takes ownership of the remaining assets. There were concerns in the tech community that until that process unfolds, some companies may have issues making payroll. Unfortunately, as we noted before, while the FDIC noted that SVB had $175 billion in deposits as of December 31st, note that some $151.5 billion of these are uninsured, which means they get exactly zero, although a sizable number of them likely pulled their deposits in the past few days. As SVB assets are liquidated, hopefully those that had uninsured deposits at SVB will eventually see some of their money. But for now, many of them are facing a complete and total nightmare. For example, one tech CEO named Ashley Turner is freaking out because she had at least $10 million deposited with SVB and has been frantically calling her banker. She said, "It has been the worst 18 hours of my life." Can you imagine how she must be feeling at this moment? Sadly, she is far from alone. The CEO of Y Combinator, Gary Tan, says that what we are looking at is an extinction-level event for tech startups. There are thousands of U.S. startups that banked at SVB, often as their sole bank. $250,000 per account is not going to last long. The number one pressing issue for these startups is payroll. You can't have people work if you can't pay them. This means mass furlough. It might mean thousands of startups die before the FDIC gets through its receivership process and releases the funds. From what I hear, there are venture debt options coming from providers like Brex, but we're going to need a lot of options in order to avoid a mass shutdown of all American startups in the next few weeks. This is an extinction-level event for startups and will set startups and innovation back by 10 years or more. Another example of a firm directly impacted, and its staff and clients, comes from Parker Conrad, CEO of HR IT finance firm Rippling, facing payroll problems. So it's not just rich venture capitalist folks who could be suffering. It's real-world businesses and their clients and employees who are feeling the direct pinch of SVB's failure today. I wish that I could tell you that he is wrong, but I cannot.